So, greetings, my beloved clients and friends. Today is October 13th, and we just got the CPI reading, Consumer Price Index. And so we were hoping that inflation was getting under control, but we got another hot read. So, core inflation was up a little bit more than they expected, and inflation was up. So, that's not good. The Fed is determined to bring down inflation, and as long as we continue to see signs of a strong economy and continued inflation, the pain will continue. The Fed will continue to raise rates, and so that's been the story for this year, and it's been a really tough market because they're saying don't fight the Fed. So we tried to be more conservative, and even doing that, we're still seeing downward pressure on the portfolio. So, I mean, winter is here. That's the thing. It could be a long winter, and I know you don't want to hear that, but we got to know it's coming, and we got to prepare, and we're probably going to raise some cash to prepare for this difficult period. And it's tough because a lot of great companies are really cheap, and that doesn't mean they're not gonna get cheaper. So eventually winter will pass, and we'll get through this. But right now we gotta bear down and endure it, and do what we can to be defensive. On like a silver lining to the situation, because Powell has raised short-term interest rates so aggressively, we can now get short-term U.S. Treasuries, which are the most liquid, safest instrument in the world, north of 4%. We could get 8-month, 9-month U.S. Treasuries between 4 and 4.25. Maybe after today, maybe even a little bit higher. So that's a pretty good parking place until we get through this, until we get through winter. And what we need to see, it's like a horse trainer trying to break a horse, you know? And this economy is resilient, and it's not wanting to slow down in face of the pressure that the Fed is placing on it. It's like a bronco, you know, and the Fed's trying to break its will. And until we see the economy put its head down, the Fed's going to continue tightening. So that's really what we're looking for. That would probably be the sign of the bottom, that the economy finally bows its head to the Fed. And one of the problems is that Biden is over there stoking the economy. By throwing billions of dollars at it. The Inflation Reduction Act, it's impossible for anything that involves spending to be an Inflation Reduction Act. And then the pardoning of all that student debt, those are inflationary. And so the Fed and the government are not working together. The Fed's trying to tighten, and the government is trying to provide more stimulus. So, and the Fed's they're gonna continue to raise rates, and they will. It's called demand destruction is what they're trying to do, and they will succeed, even if that means a lot of pain. So we've gotten super conservative in the last, well, we've been getting more and more conservative throughout the year, but even at the lows that we're at, we still want to be more conservative. It's really hard to sell some of these companies cheap, but it doesn't mean they won't get cheaper. So we are trying to raise cash to protect the portfolio. Maybe try to get down to about 50% cash allocation and throw some of that cash into those, 4% U.S. short-term U.S. government bonds, which are liquid. And we're like 8 months, 9 months is a really attractive spot on the yield curve. And we're not absolutely locked in, because a short-term security like that doesn't fluctuate much at all. If you hold it to maturity, you get back exactly what you put in plus the rate. If you sell it prior to that, you might get a little bit of fluctuation. So that's an alternative that we're looking at. But yeah, I just wanted to do a quick video to update you on that uncomfortable CPI report that came out this morning, and stay in contact with you, that I'm not hiding under the desk. Oh, it feels like wanting to do it sometimes, but stay in contact with you, let you know we're still on top of this. We're trying to make adjustments and manage through this difficult winter, and I know we'll get through it. We've been through this before, and it'll eventually bounce back. And like I said, what we're looking for is that economy to finally bow its head and said, we're not gonna spend like crazy. They're trying to induce some kind of fear into the economy, and they're very resilient. And like I said in the last video, it's possible that they're not fearful because for the last 14 years, they've experienced a Fed that always bailed them out, or a government. And so they're surprised that the Fed is not bailing them out this time. They're seeing the government still frantically trying to, but the Fed is content to let the economy experience a recession with the intention to break inflation, because in their mind, a sustained inflation is a worse than a temporary recession. Okay, so, and which I agree with. It's difficult when you're going through it, but we'll get through it, and I'm confident that the economy will survive this. I mean, if you look out past the next 12 months or so, there's a lot of exciting things happening on the horizon. One, great companies are cheap, and two, great companies are doing great things, technology-wise and healthcare, and robots. That's going to solve the labor problem, and just things that are happening with the Internet of Things, artificial intelligence. All these things are going to be massive producers of wealth, but we're just going to have to go through this winter to get to the other side of that, and we will. And we're here. And so just want to let you know that we're still at the helm. We're going through some rough waters, but we'll get to the other side. Okay, feel free to reach out to me if you have any questions or comments. Have a great day.